So it's quite easy to throw around different statements. For example, better credit infrastructure.
Drawdowns and repayments, for example, can be settled same day instead of waiting T+2 or even more. This servicing overhead that are found admin, transfer agent, or custodian charges, let's call it 50 to 100 basis points, for example, per year. In a traditional structure, well, that disappears.
What's this one challenge that you're still trying to tackle and you think is still kind of holding us back in the on-chain private credit space?
I think that for us, obviously, there is a lot of demand on-chain, right, for the capital on-chain to meet these deals. But I don't think we're close to a place where the distribution is accepted for everybody.
Hello, everyone, and welcome back to On-Chain Honestly. It's Alenka, joined, as always, by my co-host, Kaiser. Today, we're discussing one of the hugest opportunities in the tokenization space, and that's private credit. In TradFi, that's already an over $2 trillion asset class, unfortunately still heavily reliant on outdated infrastructure, manual processes, and fragmented reporting. Well, for us, people working super actively inside the industry, the remedy seems obvious. Let's just bring it on-chain. But what does it actually mean, and what are the real benefits, and what's the real economics behind this thinking? To tackle all these questions, we have two amazing guests with us today. Matteo is co-founder at Pareto, institutional on-chain credit platform, and Thibault, director at M11 Credit, one of the hugest credit managers in the space, and also the curator of the largest credit vault on Pareto. Guys, you're very welcome to the show.
Thank you.
Thank you for having us.
Right, Matteo, so let's maybe start with, well, the foundations, the beginning. Originally, the protocol, I think, was called idle finance, and it was something completely different, right? So you were trying to enhance yields through allocating capital across different lending platforms, and then you pivoted into bringing private credit on-chain. So what was behind this decision? What was behind this thinking?
Yeah, that's a really good question. And let me actually give you the entire backstory, the chronological stuff that happened from idle to Pareto, because the pivot wasn't really a single decision. It was, years of the market telling us something, essentially. We launched Idle Finance back in 2019. And as you mentioned, we were one of the first, yield optimizer in the space, yield aggregators in the space. And in doing that, in building that out during that time, working a lot with over-collateralized lending protocols first, with that many different, yield sources in the space over time, we kind of developed a very specific muscle in the sense that we started understanding how on-chain capital actually behaves. And, where it goes, what it trusts, how sticky it is, and also what makes it flee. And over time, during the idle time, two things became really clear. Well, first, yield on over-collateralized money markets, compound, the Morpho Euler now, is structurally kept. It's a function of leverage demand. And it compresses down to when you have a quiet market. And, the durable spread in finance has always been in credit in general, lending to businesses that generates, real cash flow. And, the second thing, it's also what happened in 2022 with all the crashes. We have, the Celsius, the Three Arrows, the early under-collateralized lending blow-ups. That was the kind of market screaming that credit done badly on-chain is catastrophic, in the sense that, there weren't few risk frameworks, infrastructure wasn't there to be able to handle these kind of scenarios. And, takeaways for us were not really avoid credit. It was the opposite, actually. It was the reason, the reason this blew up is that nobody has built the right institutional grade infrastructure for it. The right infrastructure that could adapt to also off-chain kind of entities and legal entities to be able to connect these two worlds. So to do that, we started thinking around, what we have with Pareto and with idle finance and how we can turn it into service credit on chain. And that's pretty much how we decided to focus completely on credit as a yield source and build infrastructure for originators and underwriters like Maven 11 here. And that's essentially how we decided to pivot into Pareto. It's we don't see it as a well, I mean, we didn't really abandon the idle thesis at the end of the day. We followed it upstream. Idle, answered the question of where should capital go. Pareto answered the question of how capital can be structured around on-chain and how can that be made composable and safe. So it's kind of like the same DNA of the company, but with a bigger problem. So yeah, that's how we decided to move into Pareto.
All right, Matteo, thank you so much for breaking it down. I think it's just like it becomes obvious that the market size here really mattered for you, right? So you just saw the limit inside those principles that DeFi originally brought. And I mean, you can always implement the same exact idea that you were trying to implement with idle finance, just moving forward, right? Anyways, Thibault, let's talk a bit about M11 Credit. So what exactly is your role in the space? Who are your target clients? And how exactly did it happen so that you met with Pareto? And how exactly are you working together these days, guys?
Yeah, thanks. I think, yeah, taking the step back as well, Maven 11 Credit is part of the Maven 11 group, and we originate from 2015 as a venture capital fund. And through the years, we expanded the business. So we really followed the industry from a venture capital seat. And we did an investment back in the days in credit, in on-chain credit, actually, in a protocol called Maple. And on Maple, there was a need for some delegation and especially for a pool coordinator. The name curator wasn't something at the time yet. It was still also a lot more TradFi oriented, where we were just plugging lenders and borrowers without this, very technical infrastructure or smart contracts in the middle. And then that was the first steps of M11 Credit as a team to basically, be a risk underwriter for lenders and borrowers and a capital connector. So from there, the ecosystem evolved a lot. We had the FTX event. We had a lot of, restructuring around these loans that moved from a lot of unsecured loans to a lot more over collateralized nowadays. And so M11 Credit followed also this trend on the side of the Maven Event Group and inside the Maven Event Group, and looking for ways to still address these Rolodex of borrowers that we knew, the same usual suspects that were maybe the clients we had on Maple. We talked to most of the prime brokers in the space because we knew that the prime brokerage engine of, the FalconX of this world, we're going to talk again about them, are basically addressing the needs of these people, providing these people with best execution and liquidity for them to execute and trade, but doing it in a sub-environment of accounts that can be collateralized. And so we targeted this market by building a leg of this prime brokerage environment and packaging it just like a private credit team would structure a credit deal. However, that's all legal and paper at this point, and we turn back to the market and just ask ourselves, okay, no, we need a partner to actually distribute it because it's just a private credit traditional deal at this point. And that's how we work together with Matteo and the Pareto team to actually tokenize this deal and actually shape, tailor-made a vault, a credit vault, as we call it, to the specifics of the covenants and all terms that we had written down in this legal paper to make it, a token on chain, a receivable token that people can use and get access to. So that's ultimately the FalconX credit vault I just described. A lot more to tell about that, but more broadly, we as M11 Credit then would position ourselves there as an asset issuer and work on Pareto as a so-called curator, where we also do this fund administration role for Pareto using their infrastructure and originating together with Pareto borrowers.
That's actually very interesting to hear that you first had this legal setup and then you went and actually, tokenized it. I think the FalconX example will be super interesting later down the episode. But before we go into the nitty gritty, there's in the show we really want to be as transparent on the language that we use. So it's quite easy to throw around different statements. For example, better credit infrastructure. But Matteo, could you actually go a bit more granular, but also succinct for the listeners, just to understand what actually gets better both on the borrowers and lender side? If you have maybe even concrete examples on that regards. When we talk about better infrastructure.
No, yeah, that's a really good question in the sense that better infrastructure is really easy to say. So let's try to be concrete and analyze each different role, each different kind of counterparty that we have inside the credit facility on Pareto, and what an on-chain infrastructure can bring compared to a traditional kind of infrastructure. For borrowers, I would say there are mainly two places of more efficiency given by an on-chain infrastructure. One is disintermediation, and another one is operational compression. In a traditional private credit facility, between the lender's capital and the borrower account, you have custodians, transfer agents, paying agents, different kind of roles that are in between the two main roles, each taking a cut and adding also days of delay before the facility can go live. A vault, a credit facility on chain, a credit vault as we call it, collapses this kind of stack into code. So subscription, redemption, interest accrual, all the waterfall and the reporting is all automated essentially. So for a borrower, financing that used, to take weeks of legal and onboarding compresses dramatically once the facility is live. Drawdowns and repayments, for example, can be settled same day instead of waiting T+2 or even more. And, this servicing overhead that found admin, transfer agent, or custodian charges, let's call it 50 to 100 basis points, for example, per year. In a traditional structure, well, that disappears because all the infrastructure is completely handled on chain with less intermediation in between. That's pretty much real money on a 9-figure facility, for example. So I see those kind of improvements and efficiencies for the borrower side of things.
Sorry, before we go to the lender, just two small questions from my side. One is, how long does it usually take to set up a vault on Pareto for a borrower?
So if we talk about the technical infrastructure to be able to release it is really quick. We are doing a beta test for a new platform, which is called Pareto Studio, which allows originators and underwriters like Thibault to self-create credit facilities. And we usually see that if the terms are pretty much clear in the originator mind, it takes 1-2 days to get the vault up and running on chain. What I usually see is the bottleneck, and this is mainly because there's still a bit of work to do between what is on chain and what is off chain is the legal side of things. We see that usually if the goal is clear for the credit facility, it takes around a couple of weeks, for example, to structure everything with also the legal side of things. So yeah, that's still kind of a dramatic improvement compared to a traditional facility that takes multiple parties in the equation.
Right. And then you mentioned that like you definitely help to bring down the cost because you're eliminating certain intermediaries in the process. That's clear. What about the interest rate though? Does it stay more or less the same for the borrower, or do you also manage to bring it down just because the appetite for yields on chain is currently maybe a bit more conservative and
Mhm.
people are just ready to take whatever is offered?
It really depends on the facility. I would say there are facilities that, for example, facilities and borrowers that are fine to convert this kind of efficiency and improved cost structure into the interest rate. I would say even FalconX facility is an example of that. Also, given all the upstream and downstream integrations that are around FalconX. Um, but also there might be some facilities where the actual borrower is looking for a lower cost of capital. So it's not really about the yield, but in general, all in all, they want to maintain the same interest rate that they can pay, but the entire cost structure of the facility is less than a traditional one. So there's no really like a specific rule for that. It can be passed to the lenders or it can be retained by the borrower. But in this way, a borrower, for example, that is really into the traditional system really see a value proposition here because they can lower down their own cost of capital by a good multiplier. And so this kind of on-chain infrastructure can provide both in this way. Can be passed to the lenders, can be passed to the borrower as a benefit for the cost-saving infrastructure.
Right. Well, judging from the returns that you can currently see on Pareto, those are very attractive, very juicy, I'd say, compared to everything else we have, at least in the RWA space. So that's a good lead up to the benefits for the lender. Sorry, I interrupted you when you started talking about it. Please go ahead.
No, yeah, indeed. Right now, most of the facilities that we see are testing these kind of benefits to the lenders also because, yeah, they see it as a way to amplify the distribution side of things. Regarding the lenders, the headline improvement is capital efficiency in general. And it's also cool because this is the part that has no TradFi equivalent. In in traditional private credit, your capital is locked. You are entering into an MLA agreement, into master log agreement. You subscribe. You are in for the term, and if you need liquidity, you're stuck because you are selling in a completely illiquid secondary market at a haircut, for example. The benefit for having a non-chain representation of the credit position that you have is that it's fully composable from day one. And that means that you can post it as a collateral. You can borrow against and redeploy. You can just borrow against in order to have other working capital for your business. So, your capital works twice in this way. It earns the credit return plus also it backs a second position, essentially. This has been proven really powerful with lenders, institutional lenders especially. And on top of that, you also have the all the benefits of having a position on chain that is like having a real time kind of reconciliation and update of all the terms. You're not relying just on a quarterly issued PDF, but you have metrics that are completely on chain that you can autonomously monitor and audit. You can have programmatic redemption instead of just a subscription paperwork. So everything is more programmatic from a lender perspective, which gives more clarity and also more confidence into holding this kind of credit position, especially if we compare it to a traditional kind of private credit position.
I think, yeah, it's very important to, highlight or even quantify these benefits and not just talk about what gets better if we, can't actually show that these are better solutions. But similar question to you, Thibault, because M11 has a bit different business model. So if you could talk a little bit about how you would compare this operational or economical efficiency compared to a TradFi setup that you guys have. And also if you could quantify, if you have ever looked into these numbers, to quantify the improvements as well, maybe even on the case of FalconX.
Yes, no, of course, I'll try my best on the quantification. When it comes to M11 Credit comparison with its peers in TradFi, I would say that we're very, crypto native as well, being Maven 11. So we come from the digital asset space, and then we took example on the TradFi space to try to bring it on the on-chain ecosystem capital formation tool. And if I split then the curator role, I think that's a good starting point to answer your question. As a curator on Pareto, curator is broad by the protocol level, right? But this is a term we always use for like smart contract functions, kind of inputs and management. I think the curator role on Pareto, especially if is a lot more than that, and you have to be good at originating, structuring, and monitoring a lot of information that are not on chain, right? So all these originating, structuring, monitoring, in what way are they, better credits on chain is very tough to understand, to answer, because even if the boards we're working with today are very, very, CeFi exposed or DeFi even exposed, and are going to be kind of, these type of players for now. If tomorrow these players are super TradFi, then these roles are still very off-chain and still very TradFi, and the way you originate, structure, monitor is still very, I would say, TradFi. But the biggest improvement for, TradFi, or just people like us being very digital asset native, but going for the credit and the writing route, I think is distribution. And as a curator, we do package a deal there, being the structurer of the deal. And then the distribution efficiency, indeed, as Matteo mentioned, on chain is very good. So as a curator, that's what we look for. We have a single receipt token we can distribute across chains and then manage very easily to access the on-chain capital environment. But then we also have, as a second very big improvement, a single point of access. So we don't have all these counterparties, transfer agents, and so on that Matteo mentioned, for all the onboarding, KYB executions, and all the cycles running, NAV calculation, interest payments. Everything is packaged into the infrastructure of Pareto, and represented by the token itself, token price updates alongside the cycles that we design and so on. So we can really represent our TradFi deal on chain through this tokenization engine. And what we're really looking for is, in a nutshell, fund administration, so accounting, settlement, syndication on chain, so we can really administrate the deal. And then distribution with all the secondary capital efficiency. That is like the pitch for broader BD as a curator, so we can distribute a better deal, a more competitive deal. So pricing the quantitative aspect then is tough one. I think the market maturity is also at some point it's very tough to compare to these traditional deals that we can see in TradFi. And I have to say, we obviously cut intermediaries. There's obvious, improvement there. But it's going to be very hard for me to quantify anything for you there.
Another question here, Thibault, since we know that you're a very digital asset native firm, right, from the beginning, as you mentioned, and you managed to work with a few other on-chain lending infrastructure solutions as well. What makes Pareto really, unique and distinct in this sense?
Well, I think that indeed, we went through the years. On-chain credits packaging a lot of providers, right? I think that pool delegation on Maple wasn't about packaging an asset and, tokenizing it. It was a lot more about plugging people together to create an environment and pool money to create an environment of utilization. Morpho by itself, for example, is a money market environment. It's still credit on chain, but very, framed as the money market environment. And Pareto is focusing on, I think, first being a tokenization engine, accounting, settlement, and syndication of, a deal on chain, but then specialized into private credits. So we really worked together with the Pareto team to, for example, when we came with this FalconX deal, address it. So as I mentioned, going into the covenants and look exactly what were the needs of the lenders and what we had to report as a structuring agency there. And so Pareto provided us with like these reporting, some loan notices automatically generated based on the deals and the accounting that they can do on chain of the netting of the inflows and outflows. And going forward, you have a lot of interest calculation going in there, negotiating the rate every period. We input that as smart contract function into the system. We, bear the responsibility, but we have the infrastructure, a single point of access with Pareto. If you want to do this with another tokenization engine, you can, but some of them are specializing in tokenizing funds. Some of them are specializing in like other private deals that are not specific to credit, for example. And this one is really tokenized on-chain credit in this specific example.
What I'm hearing is that one of the very important ingredients of success here was that you're really doing it together, right? In very tight collaboration, which is absolutely great to hear. And I love that it's an intrinsic part of the space. One more question to you guys here related to origination. So we kind of compared Pareto to Maple already. I have another platform in mind, which is Figure Markets, that, always highlights that they originate the credit on chain as well, right? So they have a separate blockchain for it called provenance. And so the original loans, HELOCs, against which different institutions can borrow money through like Democratized Prime, the lending platform, and other ways like now in DeFi as well. So the HELOCs themselves, they are originated on chain, which I think is still something different from what you just described, right? So my question to you is whether you see it as a bottleneck, as still a limit that you need to kind of underwrite a traditional, like an off-chain player, right? So the credit books, like everything is still off-chain, so you need to check it very properly. You need to do due diligence on the off-chain side, and then tokenize the structure and bring it on-chain, distribute it on-chain, do all the reporting and all the other elements and pillars that you already described during the episode. So do you see it as a limitation, and do you plan to change it in the future?
Well, it's a very extensive question. I think that Figures is indeed tokenizing a fund. I mean, I'm gonna try this one, right? Maybe I'm gonna be wrong, but basically their ELOCs is, if I'm right, some home equity line of credit that they source,
Exactly.
right? And so they source this and package it into this Figure receipt token and tokenize this package. And then you get an exposure to all these lines of credit, home equity backed, that they source, right? I mean, for us, it's completely different because we have Enphase, a single board. And I think that this is why our credit line is very different. It's basically FalconX who's the collateral manager, and we have an SPV funding very specifically one activity of FalconX. So we also have a very strong partnership in FalconX here as M11 Credit, as per being organically a partner with them, having view in their system, knowing exactly what we fund with this SPV into their system. So if I do a parallel, the SPV is participating to a certain degree into FalconX in certain activities that we framed in the legals, in the credit agreement. If we figure that out with if we do a parallel with Figure, then basically not at the SPV level, but at their package or fund level that they tokenize, they also just frame it to selecting these line of credits. I think that's the best parallel I could do. And going forward, this is all very off chain. Um, it's sorry, Matteo, I have your
No, go ahead, Thibault. No, I was agreeing with you on the on the off-chain part for figure. And to be honest, I don't see it to pick up the Alenka question about it. I don't see it as a big limitation, to be honest, in the sense that we don't need to pretend to have the world converting into the full business on chain. Of course, from an underwriter perspective, like you, Thibault, having a business that is running completely on chain, it's also easier to implement and underwrite and monitor over time. But we cannot pretend that all the businesses around the world will be integrated completely and fully on chain. We need to accept that there's going to be a hybrid kind of approach. And that's actually what we're building. We build that with FalconX and also Figure, I guess, that is, it's using the same kind of optics in order to manage the HELOC kind of investment that they have. I would say, like, my take on Figure would be that they are more, compared to us especially, they are more vertically integrated, in the sense that they
They are,
decided to
yeah,
go
for sure.
with just a single vertical, with a single borrower type and borrower profile. So they also were already kind of like, they're more like a lender rather than they already had a lending business behind. On our side, we see ourselves as more horizontal infrastructure, lower margin per
Right.
deal, but, every curator and every originator, every underwriter who joins can expand the market with us. So it's a play that is like, okay, we don't need, as credit is so broad around different areas of finance, we don't need to focus just on a single vertical, because different kind of underwriters and different kind of originators have different needs. So we need to be able, as also Thibault mentioned, and it's been paramount to work together at the beginning of Pareto, because it allowed us to understand what's the range of customization that an institutional player, for example, in this case, needs. And that's what we need to provide. And we are providing essentially a broad range of choices that an originator and an underwriter can take on Pareto protocol and Pareto platform, in order to be able to tailor the credit facility to their needs and not the opposite, which, to be honest, it was also one of the structural issues that I saw back in the days for the first wave of credit protocols in DeFi, for example. They were really strict on the kind of infrastructure that was available to the borrowers. And most of the time, the borrowers had to adapt to the protocol rather than the protocol and credit facility being able to adapt to the needs of the borrower. And our thesis is that this is what moves the needle for onboarding real businesses and expanding the kind of verticals that we can work with on-chain credit.
Sure. Yeah, well, to be fair, Figure did start with HELOCs. They are expanding the type of, clients on that side as well. But no, you're absolutely right. And I get the point, guys. But just Thibault, I was maybe more talking about, like, imagine the borrowers you'd need to underwrite. They had everything on chain. So the loans that they themselves are originating are on chain as well. Wouldn't it be like easier for you to underwrite a loan to them?
Well, yeah, it would be easier for me as a very digital native team. However, this is not the market yet. So, and
Right. Oh, yeah.
essentially also, I think, you have a lot of interest from the on-chain capital to also access these sources. I mean, to convert these businesses into sources of yield, or at least just an exposure to these, buy a credit line to these markets that are not on chain. And I think that Matteo would agree with me that this reflexivity is still something around the corner. We, for example, fund FalconX, which is a business lending out to, trading firms actually trading with collateral that are crypto as native assets. But tomorrow, the goal is maybe to move from crypto native assets as collateral to maybe more traditional assets as collateral. Guess what? We're going a way where I think these may be tokenized very quickly, a lot faster than we think. And that's for the trading and, probably the easiest example. But when we come to more SME type of loans or like, home equity lines of credit, then indeed there is a strong interest for no risk, no reflexivity with the crypto native market. Even if we're tokenized, we are just using the rails and new sources of yield and performance for the on-chain ecosystem, and that comes with not non-exposed to the rails at all businesses. So we are necessary to bring the gap, basically. Underwriting it and posting that on chain is basically our job.
Right. Yeah, Matteo, back to your point. See, so you needed to start with a particular category of the borrower anyway, right? So you opted for digital asset firms first thing, right? Like trading firms, high frequency trading firms as well, like Bastion Trade is one of your clients, right? So, but then indeed, what I saw on your website at least and across different articles that you published is this new heavy focus on payments players as well. So I think that will be kind of the next focus for the team, right?
Yeah, that is correct. Payments and in general, I would say the whole fintech area is really interesting as the next leg of and the next cohort of borrowers on Pareto that we would like to focus on. It feels like a natural next leg because they already have a clear kind of collateral behind them, all the forward flows or advanced cash against a merchant, future receivable, for example, so receivable financing. As Thibault mentioned, also asset-backed financing with more traditional assets, so less reflexivity on the collateral side of things in general. And with fintech kind of companies, what we see is that the onboarding curve and in general the learning curve in order to be able to operate an on-chain credit line has become really minimal nowadays. If we think about like 3-4 years ago, it was completely different. Right now, also thanks to a bit more clarity on the regulation side and also a bit more fintech companies becoming creating more like crypto arms inside their own companies. It's now really easy for a fintech company to be able to spin up a wallet, spin up a multi-sig wallet, take the right security procedures in order to be able to run part of their business on chain. And so payments, all the PayFi and fintech area is really interesting. It's what we're looking for, especially because with Pareto Studio we see an opportunity also to white label this kind of infrastructure. So the idea is, for example, and also picking up the point on the fact that having everything on chain is pretty much better from an underwriting perspective. Think about a neobank, a crypto neobank, let's say EtherFi nowadays, that has all the users that are transacting on chain. So they have all the financial history of their users that is completely on chain. And what they can do is essentially provide specific tailor-made credit lines to their own customers by assessing their own the financial history of their users with, for example, let's say with the help of an external underwriter. All of this is packaged into the Pareto infrastructure that we have, especially we think about that in a white label kind of approach. So that's why we see fintech and pay tech in general being the second natural cohort of for Pareto. Um, and we're really looking forward for that because it would mean less reflexivity and adding a non-crypto kind of category of borrowers into Pareto, which makes all the marketplace more diversified.
maybe also to jump back a little bit more into the lender's side, because I think during the conversation, it goes without saying that a lot of the current players, they are companies. We like to call them institutions, but obviously that's a huge, umbrella term. But talking about lenders, who actually decides whether a vault is institutional only or also open to retail investors, considering there's KYC, passing all that? Because I think looking at the platform today, a lot of the vaults are accessible to retail participants. FalconX, for example, is not. But like, what drives that distinction, and how much retail interest is there actually?
I would say that the decision is pretty much driven by the facility, not by us unilaterally, and it's it's a decision that comes between the underwriter and the borrower that defines who the facility is for, based, of course, on the borrower's requirements, because there might be different requirements depending on the borrower. Of course, the regulatory constraint, the compliance kind of requirements that each of these borrowers have, and the kind of risk profile of the facility. Right now, FalconX is using a really like traditional kind of KYC as onboarding, and it's really like institutional focused. The other facilities that we have still have KYC and still filter out by institutional kind of KYC. They're using a way to KYC that it's a bit different and less boring in some ways, in the sense that allows to connect third-party kind of KYCs from Coinbase, Binance, OKX, and leverage that in order to streamline the KYC process. But at the end of the day, also other facilities are filtering out if you are an institutional user on Binance or OKX or Coinbase, for example. So it really depends on the borrower requirement and the kind of facility that we're talking about. At the moment, if I have to look at the numbers, it's the retail participation directly on Pareto is really minimal. It's, I would say, nothing, absent in some ways. Most of the lenders that we have, all of the lenders that we have are institutional firms that are pretty much composed by credit funds, even DAO treasuries, for example, or in general, like institutional funds. So right now the participation
Matteo, I'm contributing from the retail side.
There you go. In which
You
one?
can count on me. So I was, again, like the first one I was trying to access was FalconX. Then I figured out that I cannot, because I'm not a legal a business entity. So I think the last one I entered just last week was the Fasanaro one.
Yeah, the Fasanaro. Okay, no, yeah, Fasanaro is fine with the Binance or OKX, or they have different kind of access, so they're fine with that.
I did it through Binance. I'll share my feedback with you. There is one point that I wanted to share, but yeah, no, it works perfectly. So I just hope that retail will understand that there is such an opportunity with time.
No, yeah, true. And I would say we focus more on institutional kind of distribution. There are some vaults, as as you mentioned, Fasanara, that opened up the application also to anybody that has a Coinbase or Binance or OKX account. I think there's still like room for improvements on the KYC side. So definitely happy to hear out your feedback on that. But yeah, typical lender today is pretty much on the institutional side.
Right, and guys, since we touched upon this FalconX Vault multiple times already, and that's definitely your baby of M11 and Pareto together. So maybe on a concluding note, we can definitely consider it as a very successful use case, right? That's the largest vault on the platform. And there's indeed a huge gap if we take the TVL of this vault, which is around, I think, like 170 something million versus like around 20 million for Rockaway X, which is number 2 on Pareto right now. So I'm very curious to hear your thoughts on why there's such a gap and what really accounted for, the success there. Was it just your joint magic? Like, what are the major reasons there?
Well, I can take this one, and I'll try to stay, very agnostic and not throw some on others, right? But first of all, thank you, Alenka. I really appreciate you chose ours first, and I'm sorry you didn't get in. Um, so I have to
Maybe you
say,
can make an exception for me, Thibault.
well, maybe if you found, if you have a company somewhere, we can find a way. But there is a there is, I think, very strict, a very strict setup, a lot of structuration behind this product that you don't see when you go on Pareto itself, right? If you go on Pareto, you can see that you have M11 Credit as a curator there and not on the other vault and so on, but you don't really see the back end work that came into the legals and in the weeds of these legals. So here, this is all gated, right? This is something we sign an MNDA for. We open this data room after the MNDA is signed, and then the underwriting of the actual product can start. If you stick to the token, you just see a FalconX token next to all the other ones, and they actually look all the same, right? But that's the on-chain distribution work. But we trust on-chain capital is getting professional enough to go behind that and just reach out to us, ask for the MDA to be signed, and actually underwrite the product. When you do this, I think the FalconX product do have a very extensive track record and background. We were kind of, close to the first vault on Pareto. So that's also a first, maybe first arrived type of premium we're capturing there. But secondly, it's, I think, the SPV, bankruptcy remote, ring-fenced SPV, with all the covenants that come behind. You have a first loss tranche at the SPV level. You have loan participations shared with FalconX Holdings itself. So they have skin in the game in the participated activities. You have M11 Credit organically looking into what FalconX is doing with veto rights, with legal liabilities, and all these governance monitoring that we put in place. So you have an interest coverage ratio, you have everything, trigger events, cure rights, equity maintenance step downs that we monitor, and we give that as a reporting to the LP. So again, we are in an on-chain environment where, credit on-chain can be packaged as Vault, and Vault can represent a lot of stuff, a lot of deals, a lot of funds. You can make it deal specific. That's what we did with a single exposure into FalconX. And I think that this amount of granularity with deep monitoring and legal ownership and pledges on our side as a trusted agnostic underwriter for the LP, that makes this product different from other products where we can actually package easily with borrowers that would reach out to me and say, okay, I want M11 credit. I would be, okay, what can you provide? Can you provide the collateral? How much visibility will you give me in your activities? What actually DDQ can we run together? Do we open the quantitative books of your activities together? All these we ask for, right? Otherwise, you can always build the vault and you can always syndicate, settle the funds on chain, trigger the loan, and the loan is not going in an SPV, but just in the holding. And we call that ourself an unsecured credit line.
Mm-hmm. No, yeah, just to add on top of what Thibault just said, which is very true, I would say. Because, yeah, FalconX essentially checks all the right boxes as a credit facility on chain. It has a third party underwriter like maybe an 11 that provides, kind of like an additional accountability layer for the credit facility itself. So it's really valuable. And indeed, our final goal, our long-term goal is to completely abstract ourselves. Now we know that there are some facilities that are underwritten by us, but we want to completely abstract ourselves. We are infrastructure, and that's what we want to focus on. And then also, I would say something that maybe Thibault didn't mention, but also FalconX has the full composability setup ready right now. Like it's integrated across the entire DeFi spectrum pretty much. So it bears also different kind of use cases, additional use cases for the lenders that allow also more distribution and more growth for the facility. And
Matteo, and how much do you think was the contribution of this, like for example, gauntlet integration, right? I think like at some point this receipt token was even the largest collateral asset on Morpho, right?
oh, it's really critical as a contribution. This kind of integration with Gauntlet for even the automated kind of leverage and the leverage strategy that they're offering on top of that, and then also all the other curators that picked up FalconX as a collateral on Morpho. It's been really, really important for the growth trajectory for FalconX because it's been one of the more clear use cases for the lenders and really understandable as a use case. So it for sure brought a lot of growth and momentum on FalconX. So yeah, it's definitely important on that side as well. Now the only thing that I wanted to add is that just not do because FalconX is a great facility. I think it's the flagship facility for us and for Maven 11 here. I just want to add that for other facilities that we have, it's sometimes it's not really like borrowers have capacity sometimes. Like it doesn't, if you see a facility that has, let's say, 10, 15 million, for example, it doesn't absolutely mean that the borrower can't grow or the borrower is doing something wrong. It's just that the borrower has that capital demand at the moment. So it's more about also like for FalconX, of course, they have a great business. So they have capacity to be able to process this kind of credit line. But there are some other credit facilities, and we will see them also in the future with a natural and organic capacity on the borrower side. So it's not only about the TVL most of the time for a credit facility.
That's a very important thing. I didn't even think about it to be fair. So like let's say if the TVL of the Vault of Rockaway X is 20 million, that's probably just the money that they need at the moment, right? It's not that something's wrong there. All right. So I think we've been too optimistic and too positive throughout the episode. So let's maybe add this grain of salt at the end. What is a single challenge, a single thing that still keeps you guys worried and awake at night, let's say? So what's this one challenge that you're still trying to tackle and you think is still kind of holding us back in the on-chain private credit space?
Thibault,
You
wanna?
want to start?
No, yeah, I can start. I can
Well,
start if you want.
no, I can start. I think that for us, obviously, there is a lot of demand on chain, right, for the capital on chain to meet these deals. But I don't think we're close to a place where the distribution is accepted for everybody. And I don't think that the on-chain capitals is attractive enough for some TradFi business to actually put the effort and time to build such facility to access this new pool of capital and justify that it needs to happen. But I mean, organically, that will happen. And on the origination side, I think that's the biggest challenge on our side. Monitoring, structuration, and so on. We're getting to a place where people are comfortable, partners on the custody side, if needed, on the monitoring side, if needed. Everybody is kind of building and ready to trigger. But on the origination side, that's still the biggest challenge. So we stay at the frontier of the space being, digital asset native, but we hope also that some TradFi native originators or underwriters are also going to reach out at some point to teams like Pareto, do the exercise in the other way around. I'm just here for the pie to grow at some point, and I think that this should happen also in the other way.
Yeah, I kind of echo what Thibault is saying on things that keeps me awake at night in the sense that the whole credit category risk is, something that we should be obsessed with in the sense that, I mean, defaults are structurally a component of credit. We shouldn't be saying, okay, now there won't be any default. We should assume there will be some defaults over time, especially as we scale up being able to issue credit on chain. The risk is default that is handled badly. An opaque process, legal structure that doesn't do what everyone assumed. For example, lenders that are surprised from one day to another to be sitting in the wrong waterfall or in a position that they were supposed to or expecting to be. So for us, what keeps us awake at night is also being able to give the right tools and the right infrastructure to underwriters like me in 11 to be able to manage also extreme scenarios like this one in a transparency, orderly way, as documented, as implemented on chain as well, in order to make it a known event at the end of the day, to make it part of the business at the end of the day, and being able to manage it in the right way. So I would say that's one thing, one bottleneck, or in general, one of the hard things of credit on chain right now. The other one that comes to my mind is the classic, cold start problem. It's credit is a two-sided market at the end of the day. So great borrowers won't be build a facility if there's no deep capital waiting, but deep institutional capital won't show up if there's not enough high quality facilities. So another thing that we are trying to optimize as much as possible is to solve this kind of like two-sided and cold start market. For example, by bringing institutional good quality balance sheets like FalconX one with Maven 11 on chain. So I would say that's one other thing that keeps us awake at night. It can be solved, for example, with a more clear regulation. MiCA, Clarity Act, for example, are steps towards that direction. I think there's still room for improvement on that side. I'm really looking forward for that.
Clarity, yeah. Thanks for mentioning that. That's really a very painful thing these days. But anyway, guys, thank you so much for your time. I think it was fun. Let's hope that you'll sleep well at night moving forward. And please tell FalconX that we're looking forward to the vault being open to broader audience of investors on chain.
Sounds good. Thank you so much for having us on the show.
Thank you.